So to this point in our study, we really have focused on total revenues, which is simply, remember, price times quantity. What we have yet to do, though, is to take into account the cost of items and ultimately the profit resulting for firms. And so that's what this lesson is about. So we're going to start by looking at what is profit, and profit is easily definable because it's total revenue, which is price times quantity, minus total cost. And to this point, all we've done is study total revenue. So we'll take in detail and look at cost. Total revenue is the amount received for the sale of its output. So this is what a firm is making for selling its products. Total cost is the market value of the inputs a firm uses. So this is going to be the cost of all those factors of production. So we can kind of look at this as an example. We'll look at Apple, just profit calculated, just throwing some numbers out. So if the iPad mini sells for $329.99, let's say the cost of production for each was $225.99 per iPad mini. So this will be a profit of $104 per iPad mini sold. If Apple produced and sold 50 million iPad minis, then their total revenue would be essentially about $16.5 billion. Their total cost would be about $11.3 billion. So their profit you'll see here is $5.2 billion. So that would be an awfully nice profit. Now, obviously, I'm making these numbers up, but that's how this would operate. So ultimately, what matters to any business and any economic market is the accumulation of profit. That is the ultimate goal here, is the maximization of profits. So that's their goal. Okay, so now that we know what profit is, we got to spend our time here looking at the cost of production. So the cost of production includes all of the opportunity cost of a firm in making its output of goods and services. Thus, a firm's cost of production includes explicit cost. These are the important ones, which are the input costs that require direct outlay of money by the firm. So explicit costs are the factors of production: that land, that labor, that capital, entrepreneurship. Think employees, technology, resources. And since these resources are scarce, an opportunity cost is involved in their usage. Now, implicit cost, these are input costs that do not require an outlay of money by the firm. So they result from using assets in production. Now, this results in economic depreciation, which is the opportunity cost of a firm using capital that it owns. You kind of think about it like this: you buy a car, the moment you drive a car off the lot, the value of the car drops. It's the same principle. In the use of your equipment, the equipment depreciates in value, and you have to add that into your cost because of the fact that you're going to have to replace that stuff. So economic depreciation is measured as a change in the market value of capital over a given time period. So continuing with this cost of production, when capital is used in production, it loses value over time, and this is called depreciation. And you're familiar with this concept because of cars. The fact that when you sell a car you own it, it sells for less than you paid for it because it depreciates, the wear and tear that's created. And when firms produce, the capital they use develops wear and tear over time as well, and they lose its value, which means that, of course, as it loses value, eventually they're going to have to replace it. And so a second part of implicit cost is time. Time can be equated to like wages and thus measured against the next best alternative. And now remember, when we're talking about implicit cost, these aren't things from an accounting perspective you're going to actually factor in, but it is factored as an economic aspect. But from an accounting perspective, explicit cost is really what matters, along with that depreciation. Okay, so we want to look at understanding profit. Now, because of explicit and implicit cost, profit is measured differently by economists than by a firm's accountants. Economists measure a firm's economic profit as economic profit equaling total revenue minus total cost, explicit plus implicit cost. In other words, from an economic perspective, they take opportunity cost into that measurement. So accountants, on the other hand, are measuring it as total revenue minus explicit cost because profit is the bottom line there. So economic profit is thus smaller than accounting profit since there's an added element to total cost. So to give you this economic preview of profit versus the accounting view, we can kind of look at it like this. So economists calculate economic profit as total revenue minus opportunity cost, which includes both implicit and explicit costs. So from an economic view, here you have your explicit cost, your implicit cost, your economic profit. So this right here would be your total revenue. And then this right here, of course, is your total opportunity cost. So you can see we have all of these costs We have these costs, we have a revenue, and that generates our economic profit. Now, from an accounting viewpoint, you have explicit costs, so that's the same. But then you have depreciation, but you don't have implicit cost. Rather, you have accounting profit. So you have the total revenue subtracting depreciation and explicit cost, and then you'll notice you have this accounting profit. So it's much higher. So when you look at it from an accounting standpoint, profit is much higher than you would from an economic standpoint. So as a result, economic profit in this view is smaller than the economic profit in the accounting view, which only calculates total revenue minus explicit cost and depreciation. So to kind of give you an idea, if we look at this cartoon here, it says how much did that shirt cost? Well, $13 and the pair of sunglasses I had to give up for this. So from an economic standpoint, it's not just the money that we pay, but it's also what we're giving up. So that opportunity cost, so we're thinking, okay, cash, this is all the accountant worry about. That's typically all you ever worry about, because you're really only thinking about the opportunity cost kind of in the back of your mind. But that's really what we're talking about here, is what are we giving up when we pay for that? Okay, let's talk about production. So firms operate on the basis of short run and long run production. So in the short run, firms must deal with factors of production that can be fixed or variable. So fixed factors of production like capital can only be changed in the long run and therefore have fixed cost. Variable factors of production like labor can be changed in the short run and therefore have variable costs, meaning that they can change in that short run. I mean, because you can always hire and fire more workers, but it's not like you can just all of a sudden get rid of a factory or build a new one in the short run. So that's a fixed cost. So even if you're not producing, you still pay a fixed cost. That's something you got to remember. So these factors can be increased or decreased to change the cost of production. Now, in the long run, all costs are variable for firms, because in the long run, anything can be changed. But in the short run, you have variable and you have fixed factors. So the key to, in this variable here, so the key to cost is the quantity of output that the firm produces per period. The greater the output, the higher the cost of production. And the ability to change the cost of production is dependent on the time frame for change. So now think about that. So in the long run, everything is variable, and the ability to change the cost of production is dependent on the time frame for change. In the short run, only some costs can be varied, and in the long run, all costs can be varied, because you can build new factories in the long run. You can add new technology. Okay, so let's look at this, what's called the production function. So the production function is used to show the relationship between the quantity of inputs used to make a good and the quantity of output of that good. So you can kind of look at it here when we look at this chart. So laptop production factory, this is what we're going to look at. And so labor is the variable cost at $10 per hour per worker. So you can see that here. So of course, when we have the number of workers is 0, we produce nothing. Notice we still have a cost though, because our fixed cost is always 50 and it never changes. But then the variable cost, of course, it increases by $10 for every worker we add. So whereas the fixed cost is the factory at $50, the variable cost changes. So as a result, the total cost, which is fixed plus variable, you'll notice it increases for every worker we add. So here's our fixed. So regardless of the number of workers, the cost of the factory is fixed in the short run. It's always going to be 50. So now you'll notice as the number of workers increases, the total cost of inputs increases. Do not worry for the moment, of course, of the marginal productive labor. We'll talk about that here later. What we're going to focus on here, of course, is simply the cost. So notice as the number of workers per hour increases, we see, of course, that total cost of inputs increases by $10 each time. And of course, even if we aren't going to produce anything, we're still having to pay the fixed cost at 50 for the firm itself. Okay, so now this time let's look at the marginal product of labor. So the marginal product of any input is the increase in output that rises from an additional unit of that input. Notice that as the number of inputs increase, the marginal product at first rises and then the marginal product of labor declines. So you'll notice as the outputs of laptops produced go 0, 20, 45, 60, 68, 73, 75. Notice, of course, that the marginal product of labor goes 20, 25, it increases and then begins to decrease. So when we chart that on the graph, this is what we see. Now, you've seen this earlier, of course, as we've talked about, is this diminishing returns. And that's what's happening, is essentially as we add workers, notice that we're getting less and less output from each additional worker. So it doesn't, so from that perspective, there is a perfect range of workers that we can hire. We can have too little, but we can also have too many workers. So let's talk about this diminishing marginal production. So notice that each additional input causes the marginal product to decline after worker number 2 is employed. So in other words, our perfect range of employment here is 2 employees, because after that, we're just not getting much out of them. So you'll notice here when you look at it, this is called diminishing marginal production. So you notice 20, 25, and then it begins to fall. So 15, 8, 5, 2. So the curve flattens out as the number of workers increases. Now, if we continue to add workers, the curve will reach a peak and then it'll begin to decline. So what this tells us, of course, is there's an optimum range of workers that we should employ. And just because you own a firm, if you desire to increase production, just hiring workers is not going to actually benefit you. And in fact, it can actually be a problem for you. So when we look at it here and we shade this in, we're saying these are all ranges of attainable production. Of course, anything production on the line is where we want to be. Everything outside of or above that line, of course, is unattainable. We simply cannot produce that much at this time. So why does this occur? The reason is as you continue to add workers, the space they are working in and the equipment they are using doesn't change. You know, remember our fixed cost of our factory and our equipment, that's fixed, it's not changing. So as we add workers, they're simply getting in the way of each other. So in the short run, these variables are fixed factors of production. And as a result, the workers become less efficient and therefore less productive. So having too many workers in your job is a problem that can occur within a firm. So what we've been looking at is the law of diminishing returns. So the graph shows how as workers are employed, marginal product initially rises. So you'll notice we go to here. So increasing marginal returns. As more workers are added, diminishing marginal returns takes place. So in this range here, we get diminishing marginal returns. So 1 to 2 is increasing, so it's good to hire a second worker. However, it is not good to hire the 3rd, 4th, 5th, or 6th worker. So finally, so many workers produce a negative marginal return. Here, hiring those workers actually creates a negative marginal return. It actually is damaging and it's causing our production to actually decrease. Okay, so this graph shows the marginal product of labor. Now, what you're going to notice is the point is in between each worker to emphasize the change of inputs. So when we go from 0 to 1 here, we see our point is in between. So by hiring 1 worker, we increase output from 0 to 20. Now when we hire that second worker, notice we increase from 20 to 25. So we see an increase in our marginal product of labor. So marginal product of labor is at its maximum when 2 workers are employed, but diminishes for each additional worker added. So see what happens when we go to 3, it goes down. It goes down even further when we go to 4, we go to 5, we go down to 6. So as we add workers beyond 2, we're not getting as much out of them. So in other words, it's actually costing us to hire employees. So we just need to fire everyone and just keep 2 employees. And that will actually maximize our profits and it'll maximize our production doing so. So let's examine the total cost of production. So total cost is the cost of all factors of production used by a firm. So it's what economists call explicit cost. So that's that point down there. So that is our explicit cost. So and it consists of total fixed costs, which we abbreviate as TFC. So that's our fixed cost. We'll move them off to the side. And these do not change in the short run. Regardless of the number of workers hired, it doesn't matter, fixed costs aren't changing. Now, we also include the total variable costs, so that's what we're adding to this here in purple. So when we pull them off to the side, so fixed cost plus variable cost equals explicit cost. Remember, variable costs change with each additional input. So understanding what makes up total cost allows a business to truly understand how to maximize their profits. And remember that the majority of businesses are going to be sole proprietorships. When we talk about that, the majority of businesses basically are owned. These are owned by one person. So when we look at the term sole proprietorship, think back to the fact that we're looking at basically a business that's being owned by an individual. So these people have to maximize profits since the business wealth and their personal wealth are often one and the same. Okay, so you'll see here this total cost of production. So laptop production factor. So we already said this labor is $10. That's the variable. The fixed is 50. So we have that. So then we go to here, and you'll notice, of course, we see the increase to 60, to 70, to 80, to 90, to 100, to 110. So as we add each additional worker, it's going to cost, our total cost continues to increase. So let's look at this total cost curve. So total cost is the cost of all factors of production used by a firm. So it consists of the fixed costs, which do not change in the short run regardless of the number of workers hired, and the variable costs, which change with each additional input. So when we pull that over here and we graph it, so you'll notice our total cost quantity of output. So we're looking at that very specific area here. So as we graph it, this is our total cost. So notice what happens. You'll see our total cost, we begin to see this quantity of output and our costs. So what it's telling us, our total cost curve, total costs continue to increase as we add inputs to production, yet our marginal product of labor declines. Therefore, as we go, you'll notice it continues to get steeper. So remember that in the long run, all costs are variable. So we can change that by, in the long run, increasing our factory output, maybe adding a new factory, adding new equipment, expanding the factory.